Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, November 25th, 2:15 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what is important for next week, and update the world famous 21 over 21 leaders list. Let's dive right into it. Hope everybody had a happy Thanksgiving. I certainly had a nice, relaxing, well-fed, uh, watched a lot of football and just relaxed, and it was exactly what I needed. So, state of the market. Bear market rally continues. You can see over here, market leaders acting fine. Green arrow means we're in bullish / uptrend mode there. Then as far as the five major indexes go, all five trending above their short-term 21-day and medium-term 50-day moving average. So we're showing bullish / uptrend there. Long-term, still red, and won't get off of red until we get the S&P 500 and the NASDAQ 100 doing some sort of cooperation. So still, really, it's a mixed bag there, but we weight those heavier. So we don't want to minimize the fact that we're still below the 200-day moving average on the two major indexes. So what happened today? Dull post-Thanksgiving, tight range chop. We might as well have not even opened the markets. We ended up mixed on the day among all the indices and in-house versus what we track, but firmly green for the week as we got above a key resistance level. Well, one key resistance, not all of them, but we'll go through it when we review the charts here. So the G6 lagged just barely negative, same with the S&P. NASDAQ 100 was really the loser on the day, down 0.66. Dow positive 0.45, mid-caps up 0.45, Russell up 0.3, gold diversified 60/40 stock and bond up 0.5, GROTECTION, our in-house flagship portfolio, positive 0.07%. You can see the comparison of what all of the various indexes did on the week, as I said, firmly green. So let's dive into the charts. We'll talk a little bit about Revere as we always do, try to keep it brief as we always do, and then we'll do the tail of the tape and our analysis. So here's your S&P 500. You can see just this little blip here. Trading tightly inside day relative to yesterday. Just really reflective of the overall day is what I guess you could see. So what does that mean to us at Revere, and what do we do? We're a fee-based only, fully transparent, conflict-free registered investment advisor. And our flagship portfolio is called GROTECTION, designed to grow client assets during uptrends and protect them during downtrends. Then there's a lot of grays in between there, and we're at various stages of exposure and protection depending on what our technical signals are telling us. Best case scenario is like last October, November, market trending higher above all three of the key averages. Then we start to go sideways. We take a little off the table. We start to roll over. We get more defensive, and then we break below this big black line, the 200-day moving average. That is where all severe bear markets take place. You just follow this one simple rule to avoid carnage when you're below the 200-day moving average. You don't know how long it's going to be or how bad it's going to get. A lot of that has to do with the overall tone of political and socioeconomic and geopolitical and interest rates and inflation and consumer sentiment. There's a lot that goes into it, but safe to say the opportunity is always there for the market to just hit you in the back of the head with a 2x4. And these 2x4s only come out when you're under the 200-day moving average. So to us, it makes perfect sense to get defensive or get out of the way if it's bad enough, and that's what we do, and then wait for the coast to clear, follow our re-entry rules. It's never too late to sell if you have a plan to get back in. We've got rules for participating, rules for getting out of the way. For example, we've re-engaged since this shakeout low on October 13th. We've been riding this wave higher, gaining a few percentage points for the portfolios. But when you didn't lose 27.5% on the way down, it's okay to lag as we transition from a bear market to the early stages of a bull, if that's what it is. For confirmation, very clearly, we need to get back above this big black line, the 200-day moving average. And if you're interested in an approach like this, reach out to me. Email me, don@revereasset.com. You can also email my partner, Dan Stewart. He handles client onboarding, dan@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So there's your S&P 500, nice tight inside day. Now the laggard index, the NASDAQ 100, further away from its 200-day moving average than any of the indexes are. But if you look at the equal weight NASDAQ 100, looks closer to what the healthier moving averages are, only 1.5%. And that's because, as we've been talking about, these big FANG stocks have been a terrible drag on the market all year. You know, they really led the charge up off of the COVID lows, but once you get, it's like the mafia putting the cement shoes on, you're just going to sink if that's what happens. And that's the state of the FANG type stocks right now. Let's move on to what's the anti-FANG this year, which has been the Dow Jones Industrial Average, about 7% off its highs. Pretty impressive here for the Dow, making a higher high today. Also, good stuff, riding the 8 EMA higher, very clearly the strongest from a price action standpoint of the overall indexes. Relative strength-wise, not as much over the last 2 weeks, but this is really the other indexes playing catch-up to the power that the Dow displayed over the prior month. Mid-caps, nicely above the 200-day moving average, consolidating along with the rest of the indexes. Small caps, basically closed right on the 200-day moving average. We'll see what next week brings, but lagging from a relative strength standpoint over the last 3 weeks is what small caps have been doing. Let's go to the equal weighted S&P 500, and you can see that that is above the 200-day moving average. Again, indicative of those big FANG type stocks with the big heavy weights at the top of the S&P, dragging the overall S&P down, while the mid. And you can't just say, well, why does everybody pay attention to the S&P? Why don't we just focus on the RSP, the equal weighted? Well, then you are comparing yourself to a different index, because this index lagged big time while the S&P 500 had its intense uptrend after COVID, as I just referenced a little while ago. What else we want to look at? How about the dollar, as that correlation is still intact? The dollar started out positive today, ended up basically flat, now showing a little bit negative after hours today, but it's at the bottom of the range. Extended to the downside. We're in oversold territory. Wouldn't be surprised to see a bounce here. So a lot of rubber meeting the road here across the various correlations between the dollar, interest rates, the markets, the VIX, moving averages. So interesting week next week when all of the big fat cats come back from their holiday for the Thanksgiving holiday and decide what they want to do with the markets for the last 5 weeks of the year. How about the VIX? Let's take a look at that. Up slightly today, but near the lows for the day. It's oversold around this 20 area, which has marked the bottom for volatility in April and August, and that also marked the bottom or the top for the index. As you can see, this black line up here is what the S&P is doing. It's topping while the VIX is bottoming. It's topping while the VIX is bottoming. Same situation back here in December. It's near its lows while the market is near its highs. So inverse correlation still intact there. So quite obviously something we'll continue to monitor. Gold consolidating over the last couple of days inside its range. After a nice move up, now pulling back, getting ready to decide what it wants to do next. Bitcoin acting a little bit better lately. Let's look at a 60-minute chart here. The future's showing actually flat on the day, so yeah, it really didn't do anything. So trying to take cues, seeing if there's any other shoes that are going to drop from this FTX, Almeida, Sam Bankman fraud uh, scenario, but for now, just resting at a lower level very clearly than where it was before this whole fiasco started. Let's take a look at bonds first with the TLT. We'll go to a daily chart and down on the day, which means interest rates were higher. So let's look at the TYX. The 30-year, you can see up a little bit on the day, but just a bounce so far, trending below the key moving averages and in oversold territory. Let's go to TNX, the 10-year. Market's acting like the Fed wants to pause. Powell speaks next week, and we get some inflation data, the PCE inflation data on Thursday. Powell speaks on Wednesday. That'll probably go a long way to resolving this tight action up against the 200-day moving average and overbought on indices while we're oversold on the VIX and the dollar. So there's the 10-year note. How about junk bonds? Down a little bit on the day, really just consolidating, no big deal. And the overall bond index, BND, consolidating at a higher level, highest level that it's been in for about 2 months. So that's our overall key indices that we want to look at. Let's look at Apple. This is something we have it in our focus list because it's such a proxy for the overall market. Apple weak today, down almost 2%. There's a lot going on at this Foxconn affiliate that makes their phones over in China. They basically locked it down. People are trying to escape. They brought the military in. Not a very productive work environment in any way, shape, or form. But and Apple paying the price for it. A lot of concern about what the availability for their iPhones for the Christmas holidays. So let's go to the tail of the tape now, and we'll see what's new here. Not a whole lot. Technically, indexes, dollar, bonds with a headwind, but in overbought / oversold territory at the extremes usually means a regression to the mean is in the cards. Put call ratio neutral at a 0.93, VIX at 20. We already discussed that. We're operating under the bull case, which is the rally reclaim of the 21 and the big positive reversals on CPI, the follow through day on the indexes, and then another follow through to the upside on the 11/10 CPI data. News, more China COVID lockdowns, day count up 3 out of the last 4 to 3 out of the last 5 with today's neutral consolidation day. Expectations still positive as long as we stay above this 39.50 area. You can see that's marked as resistance here, 40.60, 40.59. It'll be like 40.56, 40.57 next week when we reopen, as the S&P is still dropping on the 200-day moving average by 2 to 3 points a day. And then if we pull back, this 4,007 fib is the next level that we will be concerned about, very close to the round number psychological 4,000 level. And then the next leg down, if we break 39.50, that's when we would start reassessing the strength in the positions that we have on right now. Action today, mild gap down, tight range, dull chop. Solars and banks, really the only standouts today. Airlines too had a good day. Oil started out positive but faded. The dollar started out strong but faded. On the downside, bonds, lithium stocks continue to get whacked. There's a lot of talk about global lithium prices coming off, even though from a pure fundamental standpoint, there's a shortage of lithium for all the batteries that it's projected that we need for EVs and every other green energy enterprise going on. XLC and XLK2 tech sectors lagged, oil services lagged, XME and GDX lagged. Our focus list will go over this when we go over the 21 over 21. But first I want to show SMCI, which I will after I talk about the one portfolio change that we made today, adding another percent to this emerging solar stock SHLS. We'll take a look at the chart momentarily on that. So our adjusted beta at a 0.96, so just below the overall risk of the S&P 500. Bottom line, sleepy post-Thanksgiving consolidation day. Now, before we look at the charts, and you can let's take a look first at the key levels here. So this declining 200-day or 40-week moving average, only 14 points separating them now. So we'll be watching that next week. Two real tight closes above this 4,007, as I just mentioned. So a lot of news next week, and the reaction to that will be key. So SMCI, this has been, take a snapshot of this chart. This is perfect action for what you would want to see for a stock that had an earnings gap higher. And as far as opportunities to add if it pulled back. So on the day of the gap up, if you didn't get the initial move up right above the pivot, a perfectly plausible situation is to just wait for the moving averages to catch up. And in particular, we talk about the 5 and the 8. So if you bought it late in the day, you gave back half of your gains, and then you watched over the next week. Well, it really did nothing, but you're underwater, didn't violate anything. The key of these inflection points is the low of the inflection point day, in this case 1 to 2%, which also corresponded to the top of the base, never violated. Took 6 sessions for it to pull back and get close to the ADMA. This would have been an ideal entry point the next day. So it holds the ADMA and moves up on it. So 80 would have been a great entry point for that. Or if it hit 80 and then pulled back intraday at all. But then all you're doing is using the ADMA, the low of the day near the ADMA, or worst case, a couple percent below the low of the gap up day. So a very safe entry there, and it just continues to act perfectly, riding the ADMA higher. Gap up today, great action over the last 3 days since its last pullback in touch to the ADMA. So very often you see these leading stocks, most of the move is contained by the ADMA as it goes higher. It's really my favorite moving average for tracking stocks going higher. And you can just ride this higher until it violates the ADMA, which then would be a change in character, and it may be ready for it to base. But this looks fantastic. I know Ted has a position in this in his personal account. We didn't pull the trigger on it because of other things that we were had capital exposed to and different rules for allocating it. But this is just picture perfect the way you want a gap up and the action after the earnings gap to work. So SMCI, wanted to mention that. Now let's take a look at the 21 over 21 list. We added one stock to it, and that was anytime we own something, we want it to be in there, and as a result of it being in there, something had to go. So in this case, I kicked off nothing that is bad or negative, but I took the ETF off. We were using this as a proxy for the 5 to 6 big cap biotechs that are acting well, and this is a perfect handle that it's putting in from this cup, frankly. And we'll set alerts, and we've got alerts on all of the 5 or 6 that we're watching at the top of this, and they're kind of acting better than the overall indexes. So there's 2 indexes to pick from: IBB, which is heavily weighted at the top, 35 to 40% from these 5 or 6 big biotech stocks, and then a lot of the more speculative and smaller biotech for the rest of the portfolio. And the rest of the portfolio acts a lot like the XBI does. Now look how tight this action is. This is the speculative, more speculative biotech ETF XBI. You can see we've got alert set if this would break out of this tight range here. So biotech very clearly setting up for a move, preferably. You know the rule: when you're trending higher, you want, and this is, look on the stochastic, making higher highs and higher lows, as well as price within this base that it's forming. So if money flows into the market, I would expect XBI and IBB to act well. Don't know if the larger cap ones are going to dominate or if the smaller ones are going to play catch up, but I took it off, but there's really no reason to take it off. I just singled it out because it was the ETF. So, and what we added is this Shoals Tech Solar ETF. that so far is following that script for how you want it to act, actually acting a little better than SMCI. As you can see, its second day was an inside day. Its third day made a higher high, all above the close of day one, even though the close was inside the top of the flat base. And then, working its way higher, pulling back on lighter volume. 2 days ago was the first time it got close to the ADMA when we took our first 1% in it, and then we added another percent. Actually, I think it was Wednesday we took the first percent, and then we added a percent to it. No, I was wrong. Tuesday is when we took the first percent, and then we added a percent today. As I mentioned, when we took off that little that half of our first solar. Don't want to get too overweight on solars, but I like the fact that this is new merchandise coming out of a very nice base, big earnings gap on volume. It's following the blueprint for how we want them to act, and refer to that SMCI example that I just showed. So the rest of the 21 over 21, 20 stocks, just the same as last week. None of them violated. That's a testament to the strength of what's going on with leaders today. We'll just scroll through them right now and then wrap it up. Celsius, and again, if it's flagged, we have a position in it. We eat our own cooking here. Celsius, I personally am trying to pay more attention to shakeouts and setting some rules up for getting into these, some firm rules for making commitments to buy. This was a classic shakeout. So Celsius gapped up on its earnings day, big volume, traded up near this 100 area, acting great, started to sell off late in the day. So it was like, all right, great. Everybody's taking profits in it. Reminded me when we bought the Bros gap up last earnings report, and it sold off afterwards, but it stopped. It really stopped at the 21 on the way down. Nice couple of days after that, working its way higher up to the 100 area, which is natural resistance. You see it all the time. And then harsh pullback days again, especially it was down on Tuesday, down 3% to close, but 9% intraday. These shakeout days like this, they really serve the good purpose of getting all the weak hands out and getting the people that want the stock the opportunity to get a position in it from the weak holders. And look how it followed through the next day. We've got a small position in this, didn't add to it because of how quickly it was moving on Wednesday, but up 11.5% the next day on Wednesday, and up 5% today. So great action after the shakeout. Like I said, we're looking for more, and you can consider this an inflection point just the same as you consider the gap up day on earnings an inflection point. It's something that happens to the character of the stock to make the think of the scales of justice, so to speak, to tilt the scales to one direction or the other. In this case, it was everybody, or the boat, it's another analogy. Everybody just gets on the one side of the boat. Some people fall over and it snaps back, and the people that are remaining are the stronger holders, and they don't want to give up their shares, and anybody else that wants to buy it after that has to pay up to do it. So higher than the initial inflection point date with a very clear shakeout. Celsius looks good. Again, it needs to continue. It needs to be going to be at the mercy of the overall market, the way 75% of stocks are. But really good action over the last 2 days after something that just absolutely looked bleak, being down 9% and breaking below the 21-day moving average on the 22nd. So shakeouts, definitely something. And O'Neill doesn't talk a whole lot about them. Livermore did with a shakeout +3, which is really a shakeout plus 10%. But we're trying to quantify it a little bit better with shakeout plus a percentage of an ATR versus a moving average. So putting some rules in place to take advantage of those. And another situation was AEHR, and we'll look at this chart. I've talked very clearly about how we got shaken out of that. And it's done nothing but act great since then. You want to be on the other end of that. I was on the wrong end of it with AEHR, but on the right end of it so far with Celsius. Moving forward, GFS, this had a shakeout day too on the 17th of last week. It looks like it's a failed breakout from the 15th, down the next day, gaps down again the second day, but gets all the sellers out, holds the 21, reclaims the ADMA, closes at the top of the range, and no sellers to be found since then, just consolidating sideways, getting ready for the next move higher if the market decides to participate. And note the big blue volume bars, gotta like seeing that. So GFS, we own this, looking fantastic. ON, another one, had a big shakeout day here on the 17th. Excuse me, was it the 17th? Yes, the 17th. Tried to break out, failed, pulled back, bounced at the 21. These bounces, when you finish high in the range, that's the equivalent of a shakeout. It undercut the low of this big move out day. So anybody that was using the low of that, which would have been a really bad stop, you got to give it some room, especially with the 21 being as close to the low of that gap up day. But it bounced right at the 21. That would have been a great entry for that. And then it's showing strength since then. Boeing, this got added to one of the IBD lists today, which gave it a little bit of a goose, but no volume coming into this. I don't really want to chase it if it doesn't have any volume. I'm looking for some sign that institutions are fighting over the shares and not people picking up scraps relative to it. But as you can see, as it's moving out, the relative strength isn't really keeping pace with the price. Versus where the relative strength line was when it tried to break out of that base. I mean, it looks fine, but honestly, we only want to put our money into something that is going to do at least double of what the S&P is based on the fundamentals and the price action, and that lack of volume is not showing me that Boeing would be doing that. Wing, this has been acting weak lately, but it may just be consolidating. Tried to break out, couldn't break out, pulling back. The slope of the 21 is starting to roll over. I don't like that action at all. So this is probably the weakest of the 21 over 21. Lack of relative strength over the last 2 weeks, but it's sitting right there. Volume's been light because of the holiday. This is one that is also kind of following, but not as strong, the blueprint that we talked about with SMCI and SHLS. Very similar, undercut, held, got back above the 80 MA, but now the 80 MA is rolling over and it's down into the 21. So not the follow-up strength that you would want to see. It tried to do it on the 15th with this breakout, but no follow-up over the last couple of days. Mobileye, we continue to hold this, very volatile, tried to get above 30 today, closed back inside the base, but we survived the shakeout on it. So, and that's because we got in low on this, didn't wait for the breakout. You want to buy. Buying breakouts, you're just prone to getting shaken out. So again, this is one where we survived the breakout, or the shakeout so far. I think all three of our buys are actually positive now with this close. Maybe the last one might just be flat, and the first two are positive. Caterpillar continues to show really nice strength, and again, same situation with the blueprint for earnings gaps higher. Happened on the 27th. First pullback to the 8 was a great entry point if you took it, following up strength to the upside. ANET, this is one that shook us out. I just took it off that day. We bought it. Probably bought it on strength was probably my first mistake when it moved above there, as it looked like it really wanted to go and had volume earlier in the day. The next day is when Zuckerberg announced they were pulling back on their capital allocation, and I sold it with the changing character break below the 80 MA, closing at the low of the range. But I was the fool that sold it in this case, so I'm on the wrong end of the shakeout in this case. Really ideally going back, probably selling half and just keeping a piece of it and see if it would have started to act well. If you hold on to that piece, it'll drag you back in if it starts acting well. But for now, after booking, didn't want to deal with the wash sale. But yeah, look, I certainly could have handled this one better. First Solar, I said we took half of this off as it was extended more than 2 ATR from the 21 after a multi-day string higher. So just some offensive selling, and that percentage moved into SHLS. MedP, not really what you would, the follow-up action that you would want to see after its earnings gap. So kind of disappointing, more like Wing than like SMCI. Impinge, making higher highs inside day today. So this one looked like it was going to be a failure versus the blueprint, but reclaimed the ADMA, another shakeout here off the 21. Really, the playbook for this week has been to buy these strong stocks on weakness, not on strength, at reasonable support areas, and then your stop out is tight and you can participate in the upside without the drawdown which has been hitting basically every stock if you buy it on strength. There's been pullbacks all over the place. CEG had that type of pullback here to the 50-day moving average on 11.8 and 11.9, but continuing higher now. AEHR, this is one, like I said, we got shaken out of after 3 harsh days down, with it breaking out of this base, closed below the 21, took my shares from me, and then flipped me off and just continued to go higher. O'Reilly looking good, not really the growthiest. STNG starting its comeback trail after a couple of oddly weak days, was looking great with this move up on earnings. Pulled back, played badminton with the 21-day moving average, but follow-up strength down today, bounced at the 21, looking pretty good. Hess, this is an international oil, best exposure to take advantage of the crisis in Europe, still looking fine. Steel Dynamics, still looking great, we own that. ExxonMobil, inside day near the highs of its range. LLY continues to act well. Another one that had a 2-day shakeout, and this was tied to that goofy Twitter fake account that was set up. Again, taking advantage of a shakeout was the play for that one. Dyno continuing to trend higher, looking fine. And that's it. That's your 21 over 21 list. And I had another 40 plus stocks that very easily could have been in this list, and that's a testament to how leaders are acting, and that's going to wrap it for the week. So as always, remember, it's not how much you make in the market, it's how much you keep. We're re-engaged with about a beta even to the market as long as we're trending above the 21 and the 50-day, but the rubber's meeting the road now with us getting to this key 200-day moving average where we failed miserably last time. Had our shakeout and start of this leg up on 1013. We're participating in this, but we're coming into this 200-day moving average, and that's going to be the all critical level to see whether or not the market is going to be given a pause, a yellow light, a green light to break out, or a red light, which would be a break back below the 3950 level on the S&P. So finishing up the week ending, Thanksgiving week, finishing up the week ending 11/25. This is Don Vandenbord telling it like it is. Just the facts here at Revere. Price and volume, that's all that matters. Not your opinion, but what's actually happening in the market. Thanks for listening and have a great weekend.